Income taxes, end of chapter questions, starting with question number 1. Using the straight line method of depreciation for reporting purposes, that is financial reporting, and accelerated depreciation for tax purposes would most likely result in what? Here is the help for you. When you will use straight line depreciation, your depreciation charge will be lower. Under the accelerated depreciation, the depreciation charge would be higher. So resultantly, your income under the US GAAP will be higher because of lower depreciation charge, whereas your taxable income calculated for the tax purpose will be lower. Resultantly, your income tax expense will be higher, but tax payable will be lower. But in the future, you will have to pay more tax. This will result in a deferred tax liability. This will result in a temporary difference, and this temporary difference results in deferred tax liability. No valuation allowance, no deferred tax, rather it's a deferred tax liability, and it is caused because of temporary difference. That makes C to be the correct option. Next, in early 2018, Sanborn company must pay the tax authorities 37,000 euros on the income it earned in 2017. This amount was recorded on the company's 31st December 2007 financial statement as what? This is what we must pay in 2017 for the income earned in 2017. It's the tax payable. Income tax expense is equal to tax payable, gentlemen, plus minus changes in deferred tax assets, plus minus changes in deferred tax liabilities. This is income tax expense. So this is the amount that we have to pay. So it is tax payable, Mafi deferred tax liability. So that makes A to be the correct option. Okay, income tax expense reported on income statement equals what? Yes, now we are talking. Gentlemen, again, please note it down. Income tax expense is equal to tax payable. I'll write again what we discussed in the overview. Tax payable plus, if there has been decrease in deferred tax asset, it's added. If there has been increase in deferred tax asset over the period, it is deducted. Increase in deferred tax liability is added, and decrease in deferred tax liability is deducted. You can either use the debit credit concept we discussed in the overview, or you can use this arrangement, plug in the number, you can get your income tax expense this way. So it says income tax expense is equal to taxes payable plus net increase in deferred tax assets. Net increase in deferred tax asset. Net increase is deducted, not added. Net decrease is deducted. So this is the wrong option. Increase in deferred tax asset. No, net increase is deducted. Wrong. What is added then? Net increase in deferred tax liability. See, net increase in deferred tax liabilities is added. As you can see, DTL increase, less decrease. Net increases, deferred tax liabilities added, and net increase in deferred tax liabilities is deducted. Right? So deferred tax liabilities, net increase is added, and net increase in deferred tax liabilities is deducted. So that makes C to be the perfect option, and C it is. Analysts should treat deferred tax liabilities that are expected to reverse as what? Remember, if the deferred tax liabilities is expected to reverse, it will be considered as a deferred tax liability. If it is not expected to be reversed, it will be considered as a part of equity. Remember, if deferred tax liability is expected to reverse, it will stay deferred tax liability. But it is not expected to reverse, means we will not be required to pay tax. Then it will be considered as a part of equity. So since this one is expected to reverse, so it will be considered as a liability. If it was not expected to reverse, no reversal, then it will be considered as a part of equity. Since here it is expected to reverse, so it will be liability. That makes B to be the correct option. Deferred tax liabilities should be treated as equity when? Yes, we just discussed. A deferred tax liability should be considered equity if it is not expected to reverse. They are not expected to reverse, means we may not be required to pay taxes on such liability. Hence, no such payment is required. So it will be considered as a part of equity, and that makes A to be the correct option. When both the timing and the amount of tax payments are uncertain. We don't know the timing, we don't know the amount of tax payments. An analyst should treat the deferred tax liabilities as what? Since we are not sure about the timing and we're not sure about the amounts, so it can neither be considered as equity nor as a liability. Neither a liability nor an equity. That makes C to be the correct option. When accounting standards require recognition of an expense that is not permitted under the tax laws. Under the standards, you have to recognize an expense which is not permitted under the tax laws, which means this would result in a permanent difference. An expense under the income statement, but such an expense is never a deductible expense under the tax laws. This difference will never be sorted out, right? So these items present in one set of accounts, not in the other, not allowed in other, these will result in permanent differences. They will never reverse. Such differences are called permanent differences. That makes C to be the correct option. Next, when certain expenditures result in tax credits, these tax credits directly reduce your taxes payable. The company will most likely record what? Tax credits are neither deferred tax assets nor reported as such. So they are neither tax assets nor tax liabilities because they directly affect the taxes payable. Tax credit must directly reduce taxes and they are permanent differences, so we cannot consider them either a deferred tax asset or liability. That makes C to be the correct option. When accounting standards require an asset to be expensed immediately, but tax rules require the item to be capitalized and amortized, resultantly your accounting profit because of immediate expense will be lower than your taxable income. And this is what will happen. When your accounting profit is less than the taxable income, your tax expense will be less than the tax payable, right? You are paying more tax now, but this will benefit in you in the future. So you will have future deductible amounts. It means it will result in a deferred tax asset. That means A is the right answer. Next, a company incurs a capital expenditure that may be amortized over 5 years for accounting purposes, but for 4 years for tax purposes. It means the amortization under tax is more, amortization in accounting is less, which means your accounting profit would be more than the taxable profit because your amortization is for 5 years under the accounting system, but for tax 4 years. So since we have less amortization in accounting, so your income under the US GAAP will be more, taxable income will be less, meaning thereby you are paying less tax now because of lower taxable income, but you will be paying more tax in the future. It will result in a deferred tax liability. That makes B to be the correct option. Next, a company receives advance payments from customers that are immediately taxable. Since it's an advance payment, we haven't yet delivered goods or provided services, so they will not be recognized for accounting purposes until the company fulfills its obligation. Now in this case, as you can see, your income under the US GAAP is less because you have not recognized this cash receipt as an income. But under the tax laws, this cash receipt is your income, so you must pay more tax than the tax expense. Since you are paying more tax now, but when you will recognize it as an income, since you have already paid tax on it, you won't be paying tax in the future. This effect will reverse now. This will result in deferred tax asset. That makes A to be the correct option. Now we are talking. The components of earning before income taxes are as follows: thousands of dollars, earnings before income taxes, United States, and the foreign in dollars, and this is your total earnings in these 3 years. The components of provision for income taxes are shown as follows: federal taxes for these 3 years and current foreign taxes. These are the deferred federal taxes and these are the deferred foreign taxes, and this is the total. Okay, now this is the information that will be required for question number 12, 13 and 14. 3 questions will be linked to this information. Now first question: in year 3, the company's US GAAP income statement recorded a provision for income taxes closest to provision of income taxes in year 3. This is the current year income tax expense, and this is the deferred one. So combine these two. Income tax is current and deferred, because if you remember, income tax expense or income tax provision is equal to the taxes payable plus minus changes in the deferred tax assets and deferred tax liabilities. Right? So summing these two up, which is already done for you here, 58,772 and negative 4,628 is 54,144. That makes B to be the correct option. B it is. Next, 13. The company's effective tax rate was highest in which year? Effective tax rate, we just learned a little while earlier. Effective tax rate is equal to income tax expense divided by pre-tax income. So this is your income tax expense divided by your pre-tax income. So dividing 54,144 with 204,861 gives you 26.03. We'll do the same thing for the next year. Income tax expense in year 2 divided by the pre-tax income, 56,860 divided by 189,167 gives you 30.06. And for the third year, for the first year basically, because the time is in this order, 44,179 divided by the pre-tax income 154,733, it will give you 28.55. So the effective tax rate that has been the highest in these 3 years was for year 2, that is 30.06, and which is given in year 2 as 30.1%, rounded off. So the highest was in year 2, that makes B to be your correct option. Now, third one, this last one relating to the information we've been given. Compared to the company's effective tax rate on US income, its effective tax rate on the foreign income was lower, higher in which of these years? So this question will take some time. We will have to calculate the effective tax rate for the US operations and the foreign one, and then we'll have to compare in which of these years was the foreign income tax was higher or lower. So let's go back to the main scenario, this one. Okay, so what I'm going to do, it will be little messy, so be prepared. It will be little messy. Let me first highlight those that relate to the foreign operations. This is my highlighter. This is foreign, this is foreign, and this is foreign. Foreign, 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 right? Let us calculate these first. It's going to be 124 plus 28,140. Whatever the result comes, you need to divide it with this number. It's 24.2. We'll do the same thing for year 2. Current tax and the deferred tax added, divided with the pre-tax income, and it will give you 26.157. 26.157. All right. And then we'll do the same thing for the year 1, adding these two and dividing with the pre-tax income. It will give you 24.15. So gentlemen, this is your effective rate for your foreign income. What about the United States one? Let us write this down here. So I'm going to write it for the foreign ones. It is for year 3, 2, and 1. It is 24.2 26.16, and for year 1 it was 24.15. All right, noted. Erase. Now we are going to do for the United States operations. For this, we will take the federal current tax and federal deferred, this, and this, and we will take now this one. Adding these two, income tax expense divided by the pre-tax income before taxes, this one, will give you 29.356. Do the same thing for year 2. These two added divided by this will give you 35.91. The last one, this plus this added divided by this pre-tax income, will give you the effective tax rate of 35.507. Now you can compare that your foreign effective tax is 24, 26 and 24, and your federal United States tax has been 29, 35 and 35. So in all these 3 years, your foreign effective tax rate has been lower. Longer question, but at least it helps you learn what is effective tax rate. This is how practice will help you understand finer points. So the question was, compared to the company's effective tax rate on the US income, its effective tax rate on the foreign income was lower in each year presented. Lower in each year presented gives you A to be the correct option. Right? So A it was. Zimt AG presents its financial statements in accordance with the US GAAP. In year 3, Zimt discloses a valuation allowance, which is a contra account which reduces the balance in your DTA, deferred tax asset. So it was 1101 against total deferred tax assets of 19201. Right? So in year 1, your deferred tax assets, and year 2, let us write the comparator also. This is year 2, this was year 3. So in year 3, we have 19201 and valuation allowance is 1101. In year 2, our valuation allowance was 1325 and the deferred tax assets were 17325. Now gentlemen, this is the idea and your time is moving in this direction from year 2 to 3. So your valuation allowance has decreased from 1325 to 1101. The change in the valuation allowance most likely indicates what? Remember, whenever your valuation allowance is decreasing, it is an indication that we will have future incomes against which the deferred tax asset could be used. So a reduction in the valuation allowance is a good expectation about the future. So it's an expectation of the future earning power has increased, thereby we will be able to take benefit of the deferred tax allowance. So by decreasing the allowance, we are sure, or we are having this likelihood that future earnings will be able to recover the deferred tax allowance. So that makes B to be the correct option. Without doubt, B is the right answer. Next, Cinnamon Incorporated recorded a total deferred tax asset in year 3 of 12,301, but offset the entire deferred tax asset with 12,301 valuation allowance. Under what circumstances you will totally eliminate your valuation, your deferred tax asset? Which means you will not be able to earn sufficient income against which you can make use of the deferred tax asset. Things are bleak in the future. We expect losses in the future. So in such a case, Cinnamon most likely expects not to earn any taxable income before the deferred tax asset expires, which means we will not be able to take benefit of this deferred tax asset in the future. So that makes C to be the correct option. 20 is quite a long period as given by the US tax laws, but despite that, we may have to lower the deferred tax asset value through valuation allowance. Next question. Questions 17 to 19 relate to this information. What have we been given? The component of deferred tax assets against accrued expenses, tax credits, LIFO inventory reserves, others. This is the total of deferred asset in year 2 and 3. Valuation allowance over the period has fallen, indicating something good coming for the future. 1360 to 1245. So net deferred tax assets are 15557, 17606. Then we have deferred tax liabilities, depreciation and amortization related, compensation and retirement plans, others, total deferred tax liabilities, and net of the deferred tax assets and liabilities is the net deferred tax liability. Since your deferred tax liability is more than the assets, so the net is a liability in both of these years. All right. Question 17 to 19. First question. A reduction in the statutory tax rate would most likely benefit the companies. Remember, when the tax rate increases, your net income will fall because of high tax charge, but your deferred tax assets will increase, your deferred tax liability will increase as well. But when the tax rates fall, your net income after tax income will increase, your deferred tax assets will decrease, and your deferred tax liability will decrease as well. So in other words, we can say when the statutory tax rate decrease or increase, they both affect your income statement and balance sheet. So income statement and balance sheet are both affected by statutory tax. Tax rate affects the income statement and balance sheet item both. So that makes A to be the correct option. Next, if the valuation allowance had been same in year 3 as it was in year 2, the company would have reported 115 higher. Let us go back and see what is the whole story. This is your valuation allowance in the last year, 1360. This is your valuation allowance now, right? Valuation allowance has decreased. Since valuation allowance has decreased, meaning thereby we expect more income. We expect more income and thereby we'll be paying more taxes in the future. It says if your valuation allowance had stayed the same, what is the difference between these two? 1360 and 1245. The difference between these two valuation allowance is 115. The question says if your valuation allowance had stayed the same, 1360 and 1360, 115. Since the valuation allowance has stayed the same, reduction in valuation allowance results in lower income tax provision. Since your valuation allowance, if stays the same to 1360, in other words, year on year, there is no decrease, rather it's 115. So this would result in higher income tax expense or income tax provision. So your income tax expense would have been higher by 115. So in this case, C would be the right answer. The reduction in the valuation allowance resulted in the corresponding reduction in the income tax provision. If the valuation allowance stays the same or increases from that to 115, would have resulted in more income tax expense. That makes C to be the correct option. Next, compared to the provision of income tax in year 3, the company's cash tax payments were. Coming back to this, look at this. Overall deferred tax liabilities have decreased over the period from year 2 to 3. 23,483 to 15,033. Decrease in deferred tax liability over the period indicates that we would have paid the current year tax as well as the prior year due tax have been paid. Decrease in deferred tax liability over the period indicate that not only we have paid the current tax year for the current period, the prior year due taxes in the deferred tax liability, they have been paid as well. That's why there is a net decrease in the deferred tax liability. So it means more payments have been made in cash, resulting in the lower cash balance, and that makes A to be the correct option. Cash tax payments, of course, low cash balance but more cash payments, so the cash payments would be higher. We are not looking for the cash balance, rather the cash payments, so the cash payments would be higher. That makes B to be your correct option, because there have been more payments. Reduction in liability means the payments have been higher compared to the previous period. Next question, 20 to 22, and then we are done. A company's provision for income tax resulted in the effective tax rates attributable to loss from continuing operations before cumulative effect of change in accounting principles that varied from statutory federal income tax rate of 34%, as summarized below. We have been given 3 years federal expected income tax expense from continuing operations. Prior years there were incomes, but this year there have been loss. and this is post-tax loss at the rate of 34%. Expenses not deductible for income tax purposes means they are permanent differences, they will never be sorted out. State income taxes net of federal taxes. Changes in the valuation allowance, it has fallen over the period, indicating we expect incomes in the future. That again will result in setting off deferred tax asset, and then this is given as your income tax expense for the period. What exactly are we required? Without going into the mumbo jumbo of the requirement, we need to find out the company's net income or loss was closest to net income. This is your expected federal income tax expense for the year 3, and this is after tax, 34%. If this amount is net of 34%, what is the grossing up? When you gross it up by dividing it with 34, it will give you 329,411.76. So loss. Adding this amount to the income tax expense will give you a total of 329,411.76 plus 227 will give you a total of 556,411.76. This is the net loss for the period in year 3. 556 rounded off to 556,000. The 357 adjustment in year 3 most likely resulted in what? 357 given here in year 3 relates to expenses that are not deductible for income tax purposes. Expenses that are not deductible or incomes that are not taxable. Remember, expenses that are not deductible and incomes that are not taxable, they will always result in permanent differences. These are the permanent differences in these 3 years. So they will result in permanent differences. Increase in deferred tax asset or liability, since these are permanent differences, remember, income that is not taxable and expense that is not deductible, they will result in permanent differences. So no change in deferred tax or deferred tax liability. Why? Because these are from permanent differences. Remember, accounting expenses that are not deductible for tax purposes result in permanent differences, hence they do not affect the deferred tax asset or deferred tax liability. Next, last question. Over the 3 years presented, changes in the valuation allowance for deferred tax assets were most likely indicative of what? If you have remembered, you see this, the valuation allowance was decreasing over the period and it has fallen to quite a great extent, which means we expect the deferred tax asset to be utilized in the future. This declining balance indicates that we expect future profitability against which we might make use of the deferred tax asset. That is the reason valuation allowance has fallen. So increased prospects for future profitability, and that's the reason valuation allowance is falling. So that makes B to be the correct option.